What's up, everyone? It's Caddy with Money Vesting. So there was a really interesting report on Market Watch today that pretty much goes over how much retail traders have been dumping money into the stock market in the month of January. So I'm going to break down exactly where the money's been going to, how much per day retail traders have been pouring into the month of January in the markets, and some of the confidence levels and the divergence between retail versus institutional. And this will give us a little bit more insight into this rally, what we have seen in 2023. It'll give us a little bit more context behind the rallies that we've seen in tech and growth. And of course, we got a little bit of a pause this week where the markets were flat. Last week, the markets were red. We have seen 4 to 5 consistent weeks of green for the NASDAQ, for tech, for growth. But we're now starting to hit a wall here as there is a bit of a tug of war between both the bulls and the bears after the very strong PPI, CPI, and retail sales numbers coming in this past week. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. If you're interested in joining us, there is a link for the 16% discount, and you'll get access to all the private videos and tutorials, and of course, not to mention all the alerts included as well. So links are going to be down below. So retail traders bought up U.S. stocks at the fastest pace ever recorded in January as inflows from traders using electronic brokerages surpassed the previous peak from the height of the meme stock craze in 2021. And after shunning stocks for the safety of money market funds last year, retail traders poured an average of $1.51 billion per day into the U.S. equity markets last month on a net basis, with buyers snapping up shares of some of their favorite mega cap names like Tesla and Nvidia. Their buying coincided with the surge in U.S. equity prices after the major U.S. indexes recorded double-digit declines in 2022. The NASDAQ, home to many retail favorites, surged nearly 11% during January. It's up almost 19% so far year to date. So obviously doing really, really good. And this right here is the significant increase in the retail daily net inflows to U.S. equities, and that coinciding with the S&P 500. And you can see this massive move of $1.55 billion per day being invested in U.S. equities. And of course, S&P 500 has done really well during that time. If you compare that to March of 2020, you can see that this entire rally may have been missed by retail traders. And this right here was, again, this volume was coming down, fewer and fewer people investing, and the fact that it's very much coinciding with the S&P 500 just goes to show how bullish sentiment starts to come back in and how much of an impact the markets really have on the thinking of retail investors, right? In other words, if the markets are going higher, invest. If the markets are going down, sell, right? That's really been the mindset. That's really been the mentality. And as the markets are going down, you can see this number coming down. As markets are going down, you can see this number coming down. And as markets are pushing higher, this number is obviously going higher. More and more investors are more prone to investing in the market. Now, breaking it down by individual stocks here, you'll notice that at the top of the list, number one is Tesla. Retail net flow year to date is over $9.7 billion. And year to date performance, of course, is up the most, 74%. So doing really well. That's the highest retail net inflow that we've seen of any company out there. So Tesla, obviously the top of the list. Then we've got the S&P 500 ETF SPY at $3.5 billion. We got Amazon coming in at $1.7 billion. Apple coming in at number 4, $1.67 billion. Nvidia is going to be number 5. I was hoping Nvidia would be a lot higher, but Amazon, surprisingly so, is a lot higher than both Apple and Nvidia. But Nvidia coming in at a close 5th here, $1.4 billion, and it's also up 55% year to date. Then we've got QQQs. So we've got the NASDAQ with $1.3 billion in retail net inflows. We've got Google, both the GOOG and GOOGL Alphabet listings, $1.2 billion, 9.9% up on the year. AMD, Meta, and Microsoft all under $1 billion, but still seeing a lot of retail net inflows coming in. So this really just goes to show how much sentiment has shifted in the markets. And of course, retail is participating in a way that we've never seen before. And we are really seeing a lot of momentum for a lot of these individual stocks because of how much retail investors are literally pouring money. Like $1.5 billion per day is not a lot, not less. It's not small amount. It is a pretty substantial amount. This right here was another chart that was shared in our Discord earlier today, which I think is also very interesting. That goes to show, the confidence level between smart money and dumb money. And I don't really like the term dumb money because it's been used to refer retail traders. Smart money is always used to refer institutional investors. I don't really like that term, so I'm going to flip those up by institutional and retail. So this right here is another chart that kind of goes over the confidence, and you'll see that institutional confidence, this is the blue line, has continued to deteriorate a little bit, and it has come down even lower as retail confidence has increased over time, and it's gotten even better and better, and as the markets have pushed higher. Now, can retail actually be considered as a smart money? Because retail is the one that's actually putting money to work, and as they are, the markets are also going higher, rewarding their investing sort of a thesis, and of course their capital. And as institutionals sitting on the sidelines, you can kind of look at it in two different ways, right? There's only two ways to extrapolate this data. Number one, if institutional is correct and retail is wrong, retail is in it for a rude awakening, where if and when the reality hits and the markets actually do start to pull back, considering all the macroeconomic factors with respect to inflation and interest rates and employment, like recession, stagflation, everything that we have talked about from a more macro perspective, if that actually ends up happening, then unfortunately retail is going to be in it for a rude awakening, and institutionals wise to sit on the sidelines right now and not dumping money in as aggressively as retail has, which obviously in the short term they've been rewarded for, but maybe over time in Q2, Q3, Q4, the rest of 2023, they might be in it for some more pain as the markets come down, as the reality sets in. That's number one. Number two, the second way, which is a more positive way to look at this, is that retail has done a really good job in kind of investing and using their capital to better use. And of course, markets have pushed up, and that is going to force institutional investors to do something themselves, right? That's going to actually encourage them to start investing as the markets kind of, slips away here to the upside. And the first quarter is going to be ending. They're going to have to release their prospectus, their 13F filings. They're going to have to present their data, their returns to their clients. And that's additional pressure that they need to put money to use. And that could be seen as some type of another catalyst for liquidity. And as money starts to come back in from the sidelines, from especially institutional investors, from the big whales, which do have a lot of money, then that can even put this markets in even more significant uptrend and a bullish trend here. And we could be, looking at 4,500, 46, 4,700, and that's more on the bullish side. So there's two different ways that you can extrapolate this data. Number one, obviously, if you take a look at institutional investors, they've been a little bit more cautious than retail, right? They've always been, because their main goal here is capital preservation, because they're kind of fighting against the time. Every single year, as I pointed out before, institutional, every single year, their goal is to beat the market. Every single quarter, every single year, their main objective is to beat the S&P 500. If they can do that, then they can present it to their clients. They get all the marketing rights, they get all the bragging rights, and they can literally attract more and more money to their fund. And as a result, as their assets under management grows, as their book value grows, they're able to charge same commission fees and obviously, pocket whatever the difference is, pocket all that profit. But for retail, that's really not the case, right? For retail, like you and I, like average investors, like, small-term investors, we really are focused on the long term. Our goal is to invest in good quality companies, hold them for the long term as the business, thesis plays out, and then, exit at a certain valuation, exit at a certain profit target. We're not really too concerned about presenting our returns to anybody. We're not concerned about beating the S&P 500. Sure, over a longer time frame, you want to be able to achieve a higher return than the S&P 500, but we are really not pressured with that thesis or that mindset on a day-to-day, quarter-over-quarter, year-over-year basis, right? So that's the discrepancy that we've always had. And unfortunately, since institutionals have controlled the market because of the buying power, because of the power they have over the liquidity, that unfortunately has positioned both of these parties in a completely different way, right? Institutional is positioned for the short term, retail might be positioned for the long term. And unfortunately, when institutions start selling, market starts dropping, retail also gets a little scared, a little fearful, and we also start selling, right? So that's what we have tried to flip over time, is that retail needs to be a lot more smarter in the way that they invest. And of course, the markets are coming down. That's actually the time to be buying stocks instead of selling. And the opposite is also true. When the markets are pushing higher, it's time to actually start selling some, taking some profits off the table. Now, As I've already pointed out, there's two different ways that you can look at it. These are some other stocks that have also found a lot of bids and a lot of buyers who are stepping in. Rivian, ARK Innovation ETF, ARKK is number 27 with about $169 million being invested. Then we've got Shopify at about $154 million. We got Carvana at $147 million. That stock, people are still buying it. NIO is on the list. Lucid is on the list. Coinbase, we got AMC, Plug Power, Enphase is on the list. We got Marathon Digital, which is at $63 million, 132% gain for the year already. We got Wayfair, Medical Properties, Silvergate Capital, and Xpeng that are also on the list, with seeing a lot of buyers stepping in for these companies. But the bottom line is, again, the two ways that we can extrapolate this data. Number one is bearish. The second one is bullish. Let me know what your reasoning, what your thesis, what your predictions are. I am certainly leaning a little bit more on the bearish side only because of the macros, because I do understand the macroeconomic landscape that we're dealing with high levels of inflation. Ray Dalio himself pointing to a little bit of stagflation in the economy in 2023. And of course, the Federal Reserve also being a little bit more uncertain about where the monetary policy is going rest of the year. Do they have to raise rates? Do they have to keep raising rates? Do they have to be more aggressive, less aggressive, pause, cut? All that uncertainty is going to lean a little bit more towards the bearish side. But you never know with these institutional investors. They might feel FOMO and they might start dumping money back into the market, catapulting this rally to even newer heights. So let me know your thoughts. I'm again leaning a little bit more towards the first thesis, which is more on the bearish side. In other words, retail investors kind of creating a situation of a rude awakening eventually, but we'll find out very soon. Let me know your thoughts. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe if you're new, and hit that notification bell so you don't miss out on any future market updates and videos. Discord link down below. As always, happy investing. I'll see you all in the next video.